So in this particular section, we would now like to talk about the scope of the standard in AS 10. We say that the objective of the standard is to describe, when should you adjust the financial statements for the events after the reporting period, right? What we talked about, of course, in the initial conversation about the introduction to the standard is that I have I have my events taking place after the reporting period. So should I really go back in the previous year and change my numbers, change my presentation, change my classification or the measurement aspects? That's where you look at the word adjustment coming place. And again, you look at the disclosures that you're supposed to give for those events, right? There is a reference of something called as the date of approval and date of approval for the issue of, let's say, these financial statements, right? So what we want to talk about basically is to understand those entire context under up to what date, right? Up to what date can we go back, or can we really look at the reference of, let's say, these events after the reporting period, right? The scoping, of course, would be applicable for the accounting in terms of the adjustment, right? And then the disclosures, where you look at, of course, you don't have to go back in and change the numbers, but you would disclose, let's say, for some events after the reporting period. Okay. Now, essentially, this is something which is the formal definition. We really want to understand it well, that events after the reporting period are those events, importantly, both favorable and unfavorable. You don't take a prudent or a conservative view here. Okay. You will take into consideration even if the event is favorable, right? We talked about that example of a court case. What if the court case is in favor? Should I adjust my financial statements, for example, is something that we want to discuss it eventually. But what we want to highlight is that both favorable and unfavorable events are covered, right? That occur between the end of the reporting period and the date on which financial statements are approved for issue, right? So let's take it. Although the example is available here on the same section, I'm gonna use that basic example of my reporting period, which is 1st of April 20, and it ends on 31st of March 21. So that's my reporting period. And there is something happening after the reporting period. All right. There's something happening after the reporting period, but importantly, something that is happening up to the date of authorization, right? This is the date when my financial statements are getting authorized. And of course, there could be a date further also. So let's take a date here, which is 31st of May 21. Okay, and let's take 30th of June 21. So what are we saying here is that this particular area, this particular timeline, or the period within that timeline, is the relevant period for us. So anything that happens after the end of the period and up to the date of authorization of the financial statements, right? So any event at this point in time, or event that happens between the two dates, is referred to as event after the reporting date, which simply means that anything that happens after 31st of May is irrelevant, is not a part of this particular standard, which simply means anything that happens, let's say on 1st of June, right? This would be only considered in the next accounting period. This would only be considered in the reporting of the financial statements for the next accounting period. It is not covered by this particular standard. All right. This is something you want to remember throughout between these two dates, end of the reporting date and the date of authorization of the financial statements, right? We're given an example here. Let's say, if I look at my year, which is 1st of April 19, ending 31st of March 20. So this is my reporting date. This is the date, 10th of May, for example, the financial statements are approved for issue. So anything that happens between two dates, these two dates, right, is indeed a part of my events after the reporting period and would be covered within this Ind AS 10. Anything that happens after this date, no matter you are publishing financial informations, you are sending it to shareholders, they approve it, and then it's going for the regulation, etc. That is purely out of the scope. That's not relevant for our consideration, which actually means an event taking here or event taking place here, right, would be within the scoping of this particular standard, right? Whether favorable or unfavorable, both are considered as a part of the standard there. Okay. Date of approval now, that's the second important point if you want to understand. You need to know that in case it's a company, then the date of approval of the financial statement by the board of directors, right? And in case there is another entity, then you look at the corresponding approving authority, right, as your date of approval of the financial statements. This is the formal definition. Of course, the whole idea is that when you are looking at the date of approval by the board of directors, for example, in case of a company, the users, I would use the word shareholders, for example, must be aware of it as to what is the date when these financial statements getting approved, which actually means, by the way, they would get to know about it, that anything that is happening after that date is nowhere in this set of financial statements for that particular relevant accounting period, right? It's nowhere there, and that's what the shareholders or the users would be able to connect with, would be able to identify that, right? Just in case the owners or somebody else has the power to amend these financial statements after these have been authorized, right? Even that fact has to be disclosed by the entity. We have discussed it already. For the users, it's important to know, because I mean, as to when those financial statements were approved for issue, because otherwise anything that is happening after this date would not be covered in the set of the financial statements any which ways. Okay, let's have a look at this scenario. It's an example where we would be able to connect with the understanding of what could be, for example, an event after the reporting period. It says that directors of Safe Limited have reviewed and approved the financial statements for the year end 31st of March 2020. So let's build the timeline again. I'm looking at 31st of March 20 is my reporting date. Okay. And it says directors have approved in the meeting dated 12th of June. So let's put this as 12th of June 20. Right. We have, of course, authorization or approval by the board. A week later, okay, so let's put it like this, which is 19th of June, and then we are looking at 15th of July, right? This is the date when financial statements are issued for adoption. This is the date of AGM. Okay, the question says, what will the period considered for events after the reporting period? Essentially, we look at the reporting date and the date of authorization. So anything that happens between these two dates would be an event after the reporting period, and this is the relevant period here, right? For our question's sake, this is going to be the relevant period, and accordingly, we would say that the relevant period for event after the reporting period will be between 31st of March 2020 and 12th of June 2020 in this given case. All right, that's something which is a solution. Look at the timeline again. This is something which is the relevant period for us for all practical purposes. Okay, let's have a look at this scenario. It says that 18th of March 21, the management of an entity approves financial statements for the year ended 31st of December 2020 for issue to its supervisory board. So we are starting with this 31st of December 2020, which is our end of the reporting period or the reporting date here. Okay, the supervisory board is made solely of non-exec directors and may include representatives of employees and other outside interests. The supervisory board approves the financial statements on 26th of March 2021. Okay, we're looking at this date as, let's say, 26th of March 2021. Okay, and it says that The financial statements are made available to shareholders and others on 1st of April. So let's say 1st of April 21. The shareholders approve the financial statements at the annual meeting on 15th of May, right? And the financial statements are filed on 17th of May. This is filing. This is AGM. This is, this is the issue to shareholders. And this is, of course, the approval by the supervisory board, right? Assume year end 31st of December. It's pretty much available to us. Question is, what will the period considered for the events after the reporting period? The same question. What is my reporting period end? 31st of December 20. What is the date of approval by the board, for example? In our case, it's a supervisory board, which is 26th of March 2021. So the relevant period for consideration is going to be between 31st of December 2020 to 26th of March 2021. All right, that is something that we have got. So let's have a look at this question now. It says that on 18th of March 2021, the management of an entity approves financial statements for the year end 31st of December 2020 for issue to its supervisory board. The supervisory board is made up solely of non-exec and may include representation of employees or other outside interests. The supervisory board approves the financial statement on 26th of March 2021. The financial statements are made available to the shareholders on 1st of April, and the shareholders approve the financial statements on 15th of May, and then the financial statements are filed with the regulatory body on 17th of May 2021. So many dates, right? The question is, what will be the period considered for event after the reporting period? Now, let's start with the end of reporting date, 31st of December 2020, right? That's my reporting date, or the period end, right? We are given that on 18th of March, the management approved it. So let's say the board approval is there, right? And then we are looking at, of course, 26th of March, supervisory board comes in picture, which solely comprises of, by the way, non-executives and representatives of employees or other outside interests. We're also looking at 1st of April 21, which is basically the date the financial statements are made available. All right. We're also given that the shareholders approved on 15th of May 21. So shareholders approve in the AGM. And finally, on 17th of May, these are submitted for filing purposes. Okay. The question is, what is the period considered for events after reporting period? Again, look at what is your reporting period end. That is the reporting date. That is clearly 31st of December 20. Okay. And the date of the board approval, right? If you look at this, essentially, this is the period which is going to be considered for the event after the reporting period. So the relevant period is going to be between 31st of December 20 and 18th of March 2021. Even though there is an approval which is there by supervisory board, this is irrelevant considering the fact that supervisory board is merely executing, merely approving it, and there is no clear or a clean role that the supervisory board has got. They're more a formality from which is being followed, let's say on the relevant date, which is 26th of March, right? So we are saying that up to this date, all the events are considered to be events after the reporting period, and anything after 18th of March are outside the scope of this particular standard. All right, let's have a look at the formal solution. This is what we've got, and everything else would be not relevant for us in this case. Okay, let's have a look at yet another question. It says that Beta Limited follows 31st of March year end. Okay, In the jurisdiction where beta operates, an entity is required to conduct an AGM on or before of 30th September each year. Additionally, Beta Limited also has interim reporting requirements for its first quarter ended 30th of June, since its shares are listed on, let's say, National Stock Exchange. This is a common instance that you would see for Indian companies also. The management of Beta Limited approves and issues the financial statements for the relevant year ended 31st of March 21 in its meeting dated 31st of August 2021, right? So we are talking about, of course, 31st of March 21, and we are talking about 31st of August 21. This is my reporting date, the relevant accounting period of the reporting period. This is 31st of August, sorry. This is going to be my date of approval, right? It says that as per the Ind AS, the period between 31st of March and 31st of August will be considered after the reporting period, since the management approved. So it's a given information for us, okay? It says now, since a part of financial information, which is up to 30th of June, is already published through interim reporting, okay? You may be preparing your quarterly financial statements as per the given scenario. And it says that the question is whether the information revealed after the publication of results of 30th of June, but before 31st of August, be considered as a part of Ind AS 10, right? The whole idea is that you have already published some information up to 30th of June 21. Okay. So should you still consider those events which are arising, let's say between 31st of March, let's say to 31st of August, should they still be considered because you've already published those events, let's say, as a part of your quarterly reporting? That's what is the requirement of the case, right? Will taking into consideration the additional information create any confusion or mislead the stakeholders? That's what is the requirement. You still want to remind yourself that the very basis of those events after the reporting period is the reporting date and date of authorization, right? So even though this kind of event can happen in rare circumstances, is not something which is common to find, but if at all that happens, it does not change the scoping of this particular standard. So you still continue to, for example, you still continue to show, those events, even if, let's say, a partial information has been published as a part of the interim reporting. All right. So what we have done so far is broadly we talked about, again, as I said, that one is the meaning of what is the event after the reporting period. We look at the reporting date and date of authorization. That's something that you want to kind of consider. And of course, we look at the date of approval. For a company, it's the board of directors. And in case of any other entity, when approved by the corresponding approving authority. All right. What we want to discuss now is basically the types of events, right? Let me take or share a perspective again while we discuss that briefly in case of the introductory section there, right? We are saying that, let's say we are sitting on 1st of April 2020 and my reporting period ends on 31st of March 2021, right? And let's say this is my date of authorization, which is 31st of May 2021. So this is the start. This is my reporting period. This is my reporting date. And this is my date of authorization. Okay. So the first criteria that you always want to check, right, as far as the applicability of this standard is concerned, the first criteria that you always want to check is whether the event is an event after the reporting period or not. That is, whether it falls within the reporting date and the date of authorization or a date of approval of financial statements. Okay. So that is where you need to kind of consider that part first. Event after the reporting period. The second thing that you want to consider after having identified that whether some event is indeed an event after the reporting period, the second thing that you want to understand is that whether circumstances exist on reporting date of such event likely to take place. Whether on this date, whether on this reporting date, exist any scenario, any possibility, any circumstances such that indicate that something of that sort, something of that event actually can arise in future. Okay, that's what you want to remember at all times. Okay, are there any circumstances on this date which exist, which suggest that such an event can take place in future? Okay, say for example, we refer to that court case. Okay, normally a court case which has been ongoing many years, several months, etc. So circumstances exist in such case. Normally circumstances exist in such case on this particular reporting date, that yes, something is going to happen. There will be some outcome of this court case. If at all it happens between these two dates, then we can say, yes, this event of the outcome of the court case, it was known that something would happen. It was known on 31st of March 2021 that yes, the indications or the circumstances exist. There are indicators which suggest that something will happen. Okay, it doesn't matter whether it is favorable or unfavorable. Okay, another instance, let's assume that we're talking about, let's say, customer going under liquidation. Okay, imagine again, I'm saying that there has been a customer. So let's say there is a company X which is supposed to pay rupees 20 crores, right? So let's say this is a customer, huge customer, is supposed to pay 20 crore rupees, and let's say this is due on 30th of March 21, just before the reporting date, the money is due. Okay, but then you have been obviously connected with the customer, and he has been not really responding well, or he has not been giving you a satisfactory answer on whether he will be able to pay it in time or not, right? So he has been dealing that conversation, and you later on get to know about it that there are serious cash flow issues with this customer. Okay, those cash flows has been into, or those cash flow issues have been there for long. Okay, but you only got to know about it a bit later, let's say on, for example, 15th of May, you get to know about it that the customer has filed for a liquidation. Okay, the customer was supposed to pay you money before the due date, before the reporting date in this scenario, but he has been delaying that. Okay, and on 15th of May, you get to know about it that the customer has filed for liquidation, which actually reflects that it is unlikely that you're going to recover any money. Okay, it's not necessary, but it is unlikely in the given case that you're going to recover any money out of this 20 crore rupees, right? Now, this date is falling in between the reporting date and the date of authorization. Okay, so this date is falling between the reporting date and the date of authorization. What does it mean? It means that this event of liquidation would meet the definition of event after the reporting period. Okay, so the question is that once it has met the definition of an event after the reporting period, the question is that were there circumstances existing on the reporting reporting date that such event can take place. In this scenario, yes, in this specific scenario, it is known that the customer is likely to default, and in reality, he is defaulted as well. Okay. So what we are saying is that yes, in this case, this is going to be an instance of, let's say, where the circumstances exist on the reporting date. Okay. Versus these scenarios, let's say there is a significant physical damage to a capital work in progress, right? Which actually arose on, let's say, 30th of April. Okay. So there's an event that has taken place. The first question is it an event after the reporting period? We look at the date, which is 30th of April. It falls between the two dates, which is 30th of March and 31st of May. So it is indeed an example of an event after the reporting period. The next question is that, were there circumstances existing on 31st of March that such an event could have taken place? In this case, likely no. A physical damage, a loss, due to accident, for example, a natural calamity, right? A fire, a flood, all these instances which arise between the two dates, unlikely that the circumstances exist on the reporting date that such thing could happen. Okay. So we are talking about that understanding. Okay. So what are we trying to understand, or what are we trying to discuss here is that in case the circumstances exist on the reporting date, we adjust the financial statements to factor, we adjust the financial statements to factor in that event, right? This 20 crore rupees loss of a bad debt, as the circumstances existed, what I'm supposed to do? I would adjust my financial statements of 31st of March 2021, and I would not show a receivable in my books, but I will rather show a bad debt in my books. So I'm adjusting my financial statements. Okay. A court case, whether it's a favorable or unfavorable, if the verdict goes against me, I will probably, let's say, adjust my financial statements and create a liability, because it becomes, of course, a legal issue or a legal requirement for me. It's a legal obligation. On the other hand, if it's a favorable event, okay, when the court has probably, served a notice in my favor, right, very likely I'm supposed to show an income, right, basis the virtual certainty aspects, etc. Okay, you bring all these adjustments to the financial statements for the year ended or for the relevant reporting period. However, if I say there was a capital work in progress, let's say with respect to just a number, 50 crore rupees, and there is a physical damage, maybe because of an earthquake, etc., something took place on 30th of April. Now, the indication did not exist on 31st of March that such an earthquake would come. Okay, so it simply means that we do not adjust the financial statements if the circumstances do not exist. We do not adjust the financial statements if the circumstances do not exist on the reporting date. But what we certainly do is we give a detailed disclosure about that event, so that the users of the financial statements get to know about it, are aware of it, that something has happened. Okay, that's something that you want to remind yourself. Okay, so what we have talked about is, let's quickly formally bring it along. We are saying that my events could either be adjusting events or non-adjusting events, right? Adjusting events simply mean that we adjust the financial statements, right? Non-adjusting events simply mean that we do not adjust, but we will disclose, right? So what are the meaning of an adjusting event, or why would you say some event is an adjusting event? We say that when those events that provide further evidence of conditions that existed at the end of the reporting period, where there are circumstances which suggest that, right, such events are likely to take place. When these circumstances exist at the end of the reporting period, we need to adjust the financial statements for those events taking place. But in case there are conditions which only arise after the end of reporting period, then we do not adjust those financial statements, but we give a detailed disclosures about that. Okay. So what you want to remember here is, candidly, this is my start. This is my reporting date. This is my date of authorization. Okay. Let's say 31st of March 21 and 31st of May 21. Okay. So any event within this period is referred to as event after the reporting date. That's the first step, right? Always remember, always ask this question to yourself, right? Is this event taking place between the date of reporting and the date of authorization? If yes, then it's an event after the reporting date, right? The second question that you want to ask is whether circumstances exist at reporting date that such event can take place. Okay, it may either be a yes or it may be a no. So if it's a yes, we call these events as adjusting events. If this is no, then we refer these two as non-adjusting events, right? So there are two questions between which this entire standard would work, and that's what you want to, of course, remind yourself at all times. Okay, let's try to understand this better. There could be instances, for example, if you had any provision, or let's say you might have been disclosing those court cases, but if the court cases settled before the financial statements are approved, then you need to adjust that provision, or let's say build a new provision. Okay, there could be instances what we have discussed. Let's say a bankruptcy of a customer would normally indicate that something was always there, something was wrong. Even on the reporting date, it was evident that something was wrong. Okay, there could be an instance, for example, sale of inventories after the reporting period may give an evidence that their net realizable value is lower than the cost itself, right? So you need to accordingly accommodate that. This is, by the way, also covered through Ind AS 2 inventories, what we have discussed beforehand, and that's where the indications would start coming in. Okay, there could also be instances that you only get to know about it after the reporting period, that there were some assets which were purchased, but the true value of those assets, the recoverable amount of those assets, is not the same as the cost. It is much lesser than that, right? You only get to know about it later does not mean, please always remember, you get to know about something later does not mean that the circumstances did not exist. It does not mean that the conditions did not exist. You just got to know about it later. So if you got to know about it something later, that is not relevant. What is relevant is whether conditions existed on the reporting date. Okay. Similarly, you may have instances like determination of the reporting period of the amount of profit sharing bonus payments if there is already a legal or a constructive obligation on the entity, right? This is something which is covered by Ind AS 37 categorically about the legal or constructive obligations. You'll get to know about it from those context purposes, right? Let's have a scenario where we can try and understand this better, whether it connects with the thought process. It says that Gamma Limited has an ongoing case in High Court against the tax department. The tax department has given a show cause notice for some of the exemptions claimed by the company for the year ended 31st of March 2020. Now, this is, of course, my reporting date. The High Court has upheld the tax department's claim and issued a final order on 2nd of May requiring Gamma Limited to pay the tax as per the claim. The management of Gamma approved the financial statements on 30th of May 2020. Okay. Question is whether Gamma Limited should account for the tax in the year 1920 or in the next year, which is 2021. Okay. Of course, we need to ask those two questions. Let's try them again. We are given the reporting end date, let's say 31st of March 20. So this would be 1st of April 90. Okay. Then we are talking about, of course, the date of approval, which is 30th of May, right? And the event, which is basically the order from the High Court has come on 2nd of May, right? Right. So the first question is this event a report? Is this event an event after the reporting date, right? Since it falls between the two dates, okay, this is May, sorry, right? Since that event falls between the date of reporting or the end of the reporting period and the date of authorization, right? So it essentially is an example of an event after the reporting period. That's the first question. The second question is that whether conditions exist on the reporting date that such event could arise. Of course, it's an ongoing case, right? The final order has come on 2nd of May, but it's an ongoing case, which simply suggests that yes, the circumstances or the conditions existed on the reporting date, which makes it what? It makes it an adjusting event, which simply means we need to account for this particular adjustment in the year 2019-20 itself, right? And not wait for the next year, which is 2021, in the year in which, for example, the final order has been issued. Is it all comfortable? That's something which is very, very important for us to know, right? Let's have a look at the formal solution. It says that as for Ind AS 10, adjusting events are defined as those events that provide evidence of conditions that existed at the end of the reporting period, right? Since the case was ongoing and the order came before the approval of the financial statements, suggests that the liability existed at the end of the reporting period, which actually means the order would be considered to be an adjusting event and the liability has to be recognized in the previous year itself. There is no exception to that part. Okay. Let's have a look at this scenario. It says that Sedan Limited operates in the mid-segment vehicles. On 31st of December 19, the company had an inventory of 100 cars valued at a cost of rupees 8 lakh each. On 11th of February 2020, the government rules are enacted due to which the customers of such cars will have to pay a higher road tax and penalty. Now, due to this, the demand for the vehicles have reduced and the final price has also dropped to rupees 6 lakh. On 31st of December 19, it was understood that the laws were expected to come. The management is yet to approve the financial statements for the year ended 31st of December 19. The question is whether the entity should value the vehicles at 8 lakh rupees, which is its cost, or 6 lakh rupees, which is the net realizable value. Ignore direct cost of sales for this evaluation. Now, again, we bring that timeline. We're talking about, let's say, year ended 31st of December 19, which probably started 1st of January. Okay. And then we don't have, by the way, the date given in terms of what is the date of approval, right? So date of authorization is not known. It's open as yet. But then something has happened beforehand on 11th of February 2020. So let's say 11th of February 2020, the government ruling has come. So the question is that, again, whether this event is an event after the reporting date or reporting period. Well, we are simply saying, this is my reporting date, and the date of approval is yet to happen, right? So essentially, this is an example of an event after the reporting period, right? This is an example of an event after the reporting period. So yes, the first criteria is met. The second question now, whether the conditions existed on reporting date about such event. We have provided that it is understood that such laws were expected to come. This was known on 31st of December 19 itself, which suggests, of course, yes, the conditions existed on the reporting date, and accordingly, these events would be referred to as adjusting, an example of adjusting events. Now, what does it mean? It simply means that those 100 cars at 8 lakh rupees each would instead be valued at 6 lakh rupees, which simply means that you need to recognize a loss of rupees 2 lakh for 100 cars, which is 2 crores, and the inventory of the cars shall be measured at 6 crores, which is, of course, the net realizable value. Is it all comfortable? Right. Let's have a look at the formal solution also. We are given the definition. Adjusting events are those events that provide evidence of conditions that existed at the end of the reporting period. In this very scenario, the sale of inventories after the reporting period may give an evidence, and since that new government rule, the set of the government rules, those were although introduced later, but that evidence existed on the reporting date, which actually means you need to value those cars at the net realizable value instead of, let's say, at the cost of 8 lakh rupees per vehicle. All right. This is the section, of course, we will look at, of course, a non-adjusting event. As the name suggests, we do not adjust the financial statements, but we provide a detailed disclosure about the same, right? So if I say, for example, there could be multiple examples around that, a decline in the value of an investment, right? A major fire, for example, a business combination arising after the reporting date, right? Large changes in the asset price or exchange rates. Exchange rates keep on fluctuating. It's a typical example, a classic example of a non-adjusting event, right? So these are all instances. We talked about it, natural calamities, or an instance like a COVID, for example. They were all instances which would not exist, or there would not exist conditions that such a event can take place, right? So what you not do is, you don't adjust the financial statements, right? You simply disclose them for all purposes, right? So let's quickly try to understand whether these events given to us, whether they would be meeting the criteria of event after the reporting date, and whether these are going to be adjusting or non-adjusting events, right? It says discovery of a fraud that originated during the reporting period. Imagine the conditions existed, you only got to know about it later. It simply means the events existed and therefore it's an adjusting event. Sale of inventory is at less of cost. The prices have declined due to regulation which was expected to arise. Again, the events existed. So it's an adjusting event. Exchange rate fluctuations, very specifically non-adjusting. Nationalization of privatization by the government, it's also non-adjusting. Out of court settlement, we have done it several times. Very likely it's falling in the category of adjusting only. Okay, this is the formal solution. It is yes, yes, no, no, yes. That's what you want to always take into consideration. As you said before, you would disclose the nature of the event and also an estimate of the financial effect. Or if you can't do that, then you give a statement around that you cannot quantify what is the likely impact of, let's say, such kind of a event there, right? Of course, it's important because if you don't disclose it, well, it is likely to influence the decision making of the users as well. That's the reason why the disclosure is critical in such cases. Okay. What we want to also discuss now, of course, is the special cases. We'll be doing in the next section. Thank you very much.